Hello, this is Professor Marsh, and this is Accounting 432, Individual Income Taxes, and this is the homework video for Chapter 5. So in Chapter 5 we had the following problems. We had number 1, number 16, number 29, number 39, number 40, 44, 49, 60, and 65. So question number 1. Based on the definition of gross income in Section 61 and related regulations, what is the general presumption regarding the taxability of income realized? What I had as my answer was gross income includes income realized in any form, whether in money, property, or services, and that comes right out of the related regulations under Section 61. Number 16. Distinguish earned income from unearned income and provide an example of each. This is number 16. Okay, earned income is income from services the taxpayer performs. Unearned income is income from property the taxpayer owns. Earned income example, that would be salary. Unearned income example, that would be interest or dividends. Number 29. What are the basic requirements to exclude the gain on the sale of a personal residence? This is the Section 121 of the Code ownership test and the use test. So the taxpayer must have owned the property for 2 of the 5 years prior to sale, and we calculate 2 years by days owned. So 730 plus days in 5 years prior to sale. And then the use test is the taxpayer must have used the residence as the taxpayer's principal residence for 2 of 5 years prior to sale. And there's a third requirement. It's just a limit. You can only have one exclusion of gain on the sale of a principal residence every 2 years. Okay, number 39. Let's move on to that. These are the problems now. So this question for the following independent cases, determine whether economic income is present, and if so, whether it must be included in gross income, i.e. it is realized and recognized for tax purposes. Under A, Asia owns stock that is listed on the New York Stock Exchange, and this year the stock increased in value by $20,000. Well, there's economic income of $20,000, but it's not realized or recognized because there's been no sale. So it's unrealized gain. B, Ben sold stock for $10,000 and paid a sales commission of $250. Ben purchased the stock several years ago for $4,000. Well, Ben has economic income as follows. His amount realized is $10,000. His sales commission was $250, so his net proceeds were $9,750 minus his tax basis of $4,000 leaves him with a long-term capital gain of $5,750. That's the amount of gain realized. Okay, let's go on to the next one. And let's turn the page here. Okay, Bessie is a partner in Sulu Enterprises, LLC. This year, Sulu reported that Bessie's share of rental income was $2,700 and her share of municipal interest was $750. Okay, this is an income from a pass-through entity, and Bessie realizes and recognizes the $2,700 in rental income and realized $750 of municipal bond interest, but Bessie's entitled to exclude the $750 of municipal bond interest because under section, whatever the section is, the municipal bond interest is not taxable. So I was about to say section 101, but that's not correct. So the municipal bond interest keeps its character as it's distributed on the K1 from the partnership to Bessie, and so it's realized income, but it's not recognized. It is excluded. Number 40, Devin owns 1,000 shares of stock worth $10,000. This year he receives 200 additional shares of the stock from a stock dividend. This must have been a 5 for 6 stock split, or just a 20% stock dividend. His 1,200 shares are now worth $1,250. Must Devin include the dividend paid in stock in income? And the answer is no. Stock dividends are not taxable. That's just a division of the pie that you already own into smaller pieces. It does not increase your wealth. The reason that Devin's shares of stock went up in value is because the stock itself went up in value, and the market realizes when additional shares are issued that's just the corporation is manipulating its own share price, maybe to make it more affordable for smaller investors. Okay, number 44. Jim recently joined Austin Barter Club, an organization that facilitates the exchange of services between its members. This year, Jim provided lawn mowing services to other club members. Jim received the following from the Barter Club. Determine the amount, if any, that Jim should include in his gross income in each of the following situations. A. Jim received $275 of car repair services from another member of the club. Well, that's $275 of ordinary income. If you're paid in services, you're taxed on the fair market value of the services. Jim received a $550 credit that gave him the option of receiving a season pass at a local ski resort from another member of the club. However, he forgot to request the pass by the end of the ski season and his credit expired. Well, he should include $550 in ordinary income under the constructive receipt doctrine, because he could have exercised the value of the credit that he received. However, he forgot to do it, so that's his tough luck. He might have a loss of $550, although I doubt it's a deductible loss. C. Jim receives a $450 credit that can only be applied for goods or services from the club members next year. Well, he has $450 in ordinary income. The fact that it is restricted and not exercisable until next year may be that it is taxed next year. I'd have to probably take a look at that. I don't think that there is a deferral provision. I mean, it's certainly a valuable credit, and it seems to me that he would probably be taxed just for receiving the asset, even though it's delayed in terms of exercise. I don't think there's an installment rule for credits from a barter club. Barter clubs are a topic of great interest to the Internal Revenue Service, and they like to examine them and make sure that the members are paying their taxes on what they're exchanging. Number 49. This is number 49, the next question. Identify the amount, if any, that these individuals must include in gross income in the following independent cases. Assume that the individuals use the cash method of accounting and report income on a calendar year basis. Elmer was extremely diligent, and his employer gave him 3 additional days off with pay. Elmer's gross pay for the 3 days totaled $1,200, but his net pay was only $948. Well, for the $1,200 he received, he also had $1,200 of ordinary income. The net pay is net of the taxes and Social Security contributions that he owed, and he will get credit for the taxes paid, and he'll get credit to his Social Security account, but he still owes tax on the full $1,200. B. AMAX purchased new office furniture and allowed each employee to take home old office furniture valued at $250, and that's $250 ordinary income to each employee. It might be subject to obviously the discount is more than 20%. It might be subject to the no additional cost rules, but I really don't think so in this case. I think each of the employees has $250 of ordinary income. They were given the furniture for being an employee, not just because the company's nice. Jimmy had fallen on hard times recently. This is number 60. Question number 60. Last year he borrowed $250,000 and added an additional $50,000 of his own funds to purchase $300,000 of undeveloped real estate. This year the value of the real estate dropped dramatically, and Jimmy's lender agreed to reduce the loan amount to $230,000, for which independent situation indicate the amount Jimmy must include in gross income and explain your answer. The real estate is worth $175,000, and Jimmy has no other assets or liabilities. There's no income because of the insolvency rule. Jimmy has no other assets. He's got a loan of $230,000. He's got real estate worth $175,000. He's $55,000 underwater in terms of his net worth, and so there's no income. B, the real estate is worth $235,000, and Jimmy has no other assets or liabilities. In this case, he would have $5,000 in income. The cancellation of indebtedness rules, and he's $5,000 solvent. The real estate is worth $200,000, and Jimmy has $45,000 in other assets but no other liabilities. He would recognize $15,000 in income, although this may qualify for the real estate insolvency rule. So it could be that there would be an exception for that. So that's something to take a look at in the cancellation of indebtedness rules. But generally, the general rule is if he's $15,000 solvent, even if it's other assets, he's got $15,000 in income. Number 65, Grady is a member of a large family and received the following payments this year. For each payment, determine whether the payment constitutes realized income and determine the amount of each payment Grady must include in his gross income. A gift of $20,000 from Grady's grandfather. Well, that's not realized income. That's a gift from your grandfather. Okay. B, 1,000 shares of General Motor stock worth $120 per share inherited from Grady's uncle. The uncle purchased the share for $25 each, and the shares are worth $125 per share at year end. Well, that's not realized income either. That's an inheritance. And oh, by the way, since he received it as an inheritance, Grady has a full fair market value basis of $120 per share at the time that it was inherited, and the fact that they've gone up in value to $125 at year end doesn't matter, but it sounds like the stock's worth holding on to. C, a gift of $50,000 of Ford Motor bonds. Grady received the bonds on October 31st. He received $1,500 of semi-annual interest from the bonds on December 31st. Well, there's no tax on the gift, but Grady will have interest income for the period in which he owned the bonds. So he owned them for 2 months out of the 6-month semi-annual period, and so he'll have to pick up 2/6 or 1/3 of the $1,500 in interest, and he'll have that interest to report. And the other $1,000 of interest, we'd have to see how that would work out. It's not interest in respect of a decedent. It's probably $1,000. The gift was $5,100 since it had $1,000 of accrued interest on October 31st, and so the donor of those bonds probably owes tax on the other $1,000. 65D, a loan for school, and that's under the fruit and tree rule. That's how that works. And then D, last but not least, a loan of $5,000. There's no income on a loan. So those are the answers to the Chapter 5 homework. Hope you've enjoyed this and good luck on your midterm. Thanks a lot. Bye-bye.